You're listening to The Real Well Show with Kathy Fedke, the real estate investor's resource.
What is going on with interest rates? Where are we today and how much worse can it get? I'm Kathy Fedke and welcome to The Real Well Show. Our guest today, Richard Advani, is a real estate investor and mortgage lender based out of SoCal. Richard has been in the mortgage industry for over 16 years and specializes in working with investors for nearly 15 years now. And he's here with us on The Real Well Show to tell us what's going on with interest rates today and what we can expect. So Richard, welcome to The Real Well Show.
Thank you for having me.
It's great to have you back. I am very curious what's happening out there in the rate world. What are you seeing now for investor loans?
Well, interest rates, as we all know, some of you know, some of that sticker shock has kind of come down the last week or two. For those of you that haven't really looked at rates in a while, first thing, they are historical low, as everyone says. But look, the meat and potatoes are, they've gone up significantly. Primary homes, end of last year, start of this year, were, as we all know, a lot of us got in the high twos almost.
Yeah.
And, primary home loans today are near 5% in the last 3 or 4 months. We've seen, obviously, rates go up substantially. Investor loans are currently pushing now in the high 5% for conventional loans. So, it has made and continues to make a big difference for a lot of us in terms of, I think, really how we're looking at numbers. But the good news is, if you look at the broad scope of real estate and the positives of it and, the investment aspect, I still think it is one of the better investments available to us consumers right now.
Yeah, I agree. If inflation's at 8.5%, but we're still able to borrow at 5 or 6%, that's good. That means you're still making money, in my opinion. Especially when we know that over time it's your tenant that pays that mortgage payment down for you. And as far as first-time buyers, we saw rents go up 20%, some areas 30%. So being locked into a fixed rate, to me, gives an enormous amount of financial security.
Agreed. And one thing I'd like to kind of touch on, a lot of the conversations that we're all having with clients these days are really, I heard the feds are going to raise the rates, and they're going to continue to raise the rates. And oh my God, what mortgage rates have already gone up so much. Where's that kind of going to leave us? And, the first thing I want to touch base on is if everyone watching isn't aware, mortgage rates really aren't based on the Fed rate. Now, the Fed rate, the prime rate, obviously has its effect on everything a little bit, but mortgage rates are based on the 10-year Treasury bond. And if you out there have a smartphone and you go to your stock section and type in TNX, you'll pull up a graph of that 10-year Treasury bond, and you'll see that Treasury bond started off the year in the 1.2, 1.3 range, and today it's closing close to 3%. So, kind of take some of the mystery away from consumers of if you call someone like myself today and a week later, what kind of drives the rates and the differences. Generally, if you see that Treasury bond move up, it means, mortgage rates are probably moving up with it, and vice versa.
Yeah, it is really important for people to understand that, because we do constantly hear that rates are going up. And usually that means the Federal Reserve overnight lending rate, the Fed fund rate. And people do get confused, although they also tend to go hand in hand, right? If the Fed is raising rates for banks then are going to lend to someone like me, it's going to go up. They tend to want a 3% spread, right? From what they borrow it to what they lend it for.
Exactly.
Yeah. And then with the 10-year Treasury, what's driving it up? Can you speak to that?
That's a tough one, especially because there's so many factors internally within the U.S. as well as geopolitical outside of the U.S. factors. Obviously with the Ukraine crisis right now, interest rates, that has had a negative effect on the overall bond market and interest rates and kind of pushed them higher. I'd say the general consensus, at least for, what I've been paying attention to, is hopefully a lot of the increase we're going to see in rates for the remainder of the year are here. Now, that doesn't mean they're not going to move up, but, they've doubled almost already. They've gone up a couple percent, 2%, let's call it. Are they going to go up another 2% My opinion, I'm not an economist, but my opinion is I think that's unlikely. There definitely is room for them to move up another quarter to 3/8%, which, for investors, as we discussed, means we have to kind of look at real estate a little broader. And, we'll get into that, obviously, what I mean here.
Yeah. Yeah. It's funny because people want it all, right? People want to have low rates, but they don't want to see home prices go up so much and they don't want bidding wars. But you can't have both. If you have really low rates, that's meant to stimulate the economy, right? And it allows more people to buy. And then as more people buy, prices go up, and then the Fed has to, raise rates to slow that down. So here we are in a situation where these higher rates will slow down this frenzy. And that's what the housing market desperately needs. So let's embrace it. This is a good thing. Higher rates is a good thing. Prices were getting out of control, and it's just time to rein it back in.
Exactly. And I mean, the interesting thing is, yes, demand has dropped. And as you said, that's healthy because of how crazy it was. Now, that doesn't mean homes aren't being sold, though, right? Instead of 50 people waiting in line to buy a house, now there may be 20. But, the reality of it is, as you know as well, in the next decade, I think nationally we're on track to build half of the homes that we need. And, regardless of rates, regardless of the economy, that supply and demand issue isn't going to be cured or resolved. So yeah, I mean, I'm still in. Everyone asks me, the first question they ask me is, "Are you still buying real estate?" And I've got a couple dozen properties myself, and the answer is yes, always. And if the market changes a little, much like stocks and securities, we dollar cost average. Potentially buy a little more, but
Yeah. Yeah. John Schaub is somebody that I've followed, and he wrote a book on building wealth one house at a time. And he said, just buy one every year, regardless if it's up or down. It is the dollar cost averaging, like you said. Okay, so what has, if anything, changed in the lending world? Is it getting harder to get loans, or easier, or the same?
that's a good question. Well, it depends on who you talk to, of course, and what they have access to. As you know, I'd worked at Wells for almost a decade. The team and I left January of last year. And, besides, things got a little difficult to get done there transactionally for clients, but also a lot of our mutual clients have really graduated above that 10 finance property limit. And we now have access to programs for clients that, need to go above 10 loans, or, maybe they're self-employed and they're just like, what, I'm not willing to pay enough taxes to qualify for a loan. We have low documentation programs available. So overall, I would say the market has warmed up rather to investors with a lot of these non-traditional programs available as well. Fannie Mae also has, they've removed a lot of the restrictions they had over the last decade. In the last 2 or 3 years, you can put 15% down on a single family rental property, which, to me is obviously a positive sign. One change that has occurred, I think, and some of it may have been a little bit of the abuse by us consumers, but about 2 months ago, Fannie Mae kind of changed their pricing structure on second homes, vacation homes. And whereas vacation homes typically were priced similar to a primary home in terms of interest rate, now what we've seen is Fannie Mae has now priced them closer to rental properties. So there still is a benefit to put less down if you're buying a short-term rental or a vacation home that you may rent out on the side, but that interest rate benefit has kind of gone away. So I'd say that's the only real negative change I've seen. But overall, I think it's warmed up a lot to investors, and there are a lot of non-traditional products available out there at our disposal as well.
Yeah, I have heard that some of the non-traditional, there's so much money looking for yield that sometimes there's even better rates there. Have you seen that to be true?
There were for a little while, about 60 days ago, or 90 days ago, as rates started moving up pretty sharply. We saw a brief period where these non-traditional rates were actually on par with, if not a little lower than Fannie Mae loans. That only lasted, unfortunately, a couple weeks. In having conversations with those lenders, the margins that they like to keep are about 1% higher than Fannie Mae. So, they took a little while longer to raise them than Fannie Mae rates, but they did actually move up as well. Right now, they're above Fannie Mae loans.
And then conventional loans, it's still limited to 10, Fannie or Freddie.
Correct. Yeah.
Oh,
Currently,
okay.
Fannie Mae is, kind of limited to 10.
Okay. And what about the non-conventional?
Non-conventional, there really is no limit. They are going to do a little bit of a case-by-case review, but with these non-traditional loans, if you own a primary home and you're putting 20% down, there are no income documentation, right? There's no pay stubs, no W-2s, none of that needed. The lending is really based on the collateral on the property itself. Look, you can't be a deadbeat, right? You have to have a good credit score. You have to have money for the down payment, and you have to own a primary home and have an overall good profile. But assuming you do, 20% down, and you can go and buy rentals with no real limitations. And when I first heard of it, I was kind of wondering, okay, well, what's the security to the lender, to the investor? And as you said, a lot of these are hedge funds potentially looking obviously for a return. And it really, really made me appreciate how these hedge funds that obviously pay a lot of money for research and stuff, how robust they see housing still projected to be into the near future, that they're willing to make these loans with minimal income documentation for the right client, with just 20% or 25% security in the property. Their security comes from the fact that they have that, plus it's a cash flowing investment. A lot of these hedge funds have single family or multi-unit rentals on their own portfolio. So to me, once again, it kind of gave me a little more of confidence, moving forward in terms of the next 3 to 5 years.
Okay. Are you starting to see more 40-year interest loans versus the 30-year?
We are seeing the 40-year interest only loans grow in popularity. Well, let me rewind a lot of investors, and most investors are kind of chasing the ROI, right? The cash flow. And, we see that mainly with newer investors because that's how they've been, taught to invest and evaluate properties. And I'm not saying that's wrong. However, anyone that's owned real estate over a decent chunk of time, 5 years, 8 years, 10 years, and beyond, really knows that real estate wealth, in my opinion, isn't built overnight. It's not built on the cash flow, your 7% or 8% number, whatever number you have in your head. That's not where you build real estate wealth. Real estate wealth is built over time, and it's built through things other than just that front end cash flow. Well, once again, it is important to evaluate a property, but what a lot of us don't take into account is the return on amortization, right? Even if you're making in these days a low single digit return cash on a rental property, don't be blind to all the other factors that influence it as a real estate investment. Generally you're going to make a couple percent in principal pay down, or your tenants making that payment for you, and you're paying down your balance. On top of that, and of course, consult your tax professional, but most rental income for us investors is tax-free because you're able to use depreciation to offset that rental income, which, if you look at your tax bracket, you're 40 to 50%. Well, that adds a percentage to your ROI as well. So I'm not saying don't look at cash flow. It is important to evaluate a property, but don't let that be your all in, of whether you're going to invest in real estate or not, because, once again, you do build that wealth over time and on the long term. So back to your question on the 40-year interest only, yes, it is growing in popularity. It allows you to gain that percent or 2%, front end return if that's what you're after. And one more thing I'd like to say is, I've seen a big shift on that same note in terms of the type of investors we're dealing with, right? There's a lot of people that have done very well in the last decade in whatever investments they were in. Let's call it the stock market, for example. And there's a lot more people out there right now looking at real estate, not for that 7% ROI, but looking at as, kind of a vehicle for estate planning and asset protection vehicle, to where, they're trying to spend some of their gains or deploy some of their gains from stocks, and they're willing to put 50% down on the same properties you and I are trying to buy. And there's a lot of people like that. because in the long term, obviously, real estate is proven to be, obviously a great investment. And the last thing I'll kind of say on that note is, and in talking to a lot of our mutual clients who are kind of just one dimensionally looking at, my cash on cash return, as I ask them, what are you going to do with that cash on cash return? Let's say it's 8%, which is what you're after. That 8% is $320 a month, right? Great return. But what does that $320 do for you? And most of the time it's, maybe one good dinner, maybe a couple, and I think that's very powerful to kind of get their mind off of one dimensionally, looking at that. And it helps them kind of realize that what they want out of real estate is not just this ROI. It's what we all want in the long term, the wealth building aspect of it. The fact that once you own rental real estate for 6 years, 10 years, the amount of principal pay down dramatically goes up every month. Rents go up. It's a good hedge against inflation. So, for me, when people ask me if I'm still investing, yes, I don't know anywhere better to invest, at the moment.
Yeah, I could not agree more. We had a fund, a single family fund that we're just closing out this year. And we learned a lot from that because within the fund, we bought properties in growth markets like Georgia and Florida, and then also in the cash flow markets of the Midwest. And we were trying to balance it out with high cash flow and not so much growth with low cash flow and high growth. And at the end of the day, when we sold all the properties and looked at the full ROI of appreciation plus cash flow, the growth markets were 6 to 10 times more productive, more income to the fund than just straight cash flow. So if it just kind of depends on where you are in life. Obviously, if you're just living off your properties and you need that cash flow, then you're going to want to be in higher cash flow markets. But you need money. You need to have a certain amount of money. If they're leveraged, you're again, like you said, you're not going to make that much, just a few $100s. Whereas over the long term, if you buy good, solid properties in growth markets and hold them, you've got your retirement set, because by the time you need that cash flow, it'll be there for you.
Exactly. And to that note, I mean, there's a lot of people in California and other metros that have had properties for 15, 20 years. I just finally convinced my mom after 30 years to sell our childhood home, because it was a 3-bedroom, 2-bath, 1,200 square foot house that she rented out and made $4,000 a month. Well, it was worth $1 million in this market. And, we're able to do a 1031 and, buy one property cash right away, which made her the $400,000. And then buy 7 more with that additional $500,000 in proceeds. And, talk about not only a dramatic increase in cash flow, she tripled her cash flow, and to good assets, right? Good strategic growth markets. Not only that, she actually got to a point now where she's more diversified, right? If she had tenants in that one home that she prized, which I understand the security that it gave her over the last decade, but once I was able to open her eyes and see really, hey, it's dangerous to have just this one asset, but you diversify and increase cash flow. There's so many people like that are sitting on properties, once again, they've had for a while or inherited, and they're kind of afraid to venture out into other markets. And what I tell you is, don't be afraid. Talk to your investment counselor at Real Wealth, and they'll actually map it out with you and show you, hey, if we deployed it into this, and this is what you could do with that same chunk of equity you have, and with that 1031. So don't be afraid to explore those options. And, when you're selling a high value property like that, it makes you really powerful in terms of strategy and planning. You could put 35, 40% down on a property and make it work. Go ahead. Sorry.
Oh no, I just completely agree. Having all your eggs in one basket is never a good thing. And so if you have one high priced property with one tenant, that market could go down in value, or that tenant could come and, have issues. There's, even in a strong economy, individuals have things that happen, divorce, illness, there's things that can happen that might affect your tenant. So if you take that $1 million property and 1031 exchange it into, say, 5 $200,000 properties, or whatever it is you choose, now you have diversified maybe into different markets or different neighborhoods within one market, and now you've got more tenants that the chances of all of them running into issues and not being able to pay are pretty low versus having that one tenant. Yeah, it's a good time to really reevaluate what you want out of your portfolio.
Definitely agreed. And as you said, the right answer is going to be different for every person, depending on where you are in your investing life, where you want to retire, and so forth. So the planning aspect. There's no right answer for everyone. So educate yourselves online, but it's important to actually talk to a physical person, so you can kind of get a tailored plan to yourself.
Yeah, and if you're worried about interest rates, talk to somebody who's been a real estate investor for more than a decade. Because I can tell you, back in the day, my dad was so thrilled when he could refinance into a 9% interest rate. He had been at 12%, and before that, 15%, of course, in the 80s. But it was right around 1997 when I started to get interest. That's when we bought our first property, and it was 7-8%. And we thought that was great. That was like the lowest it had been in a long time. So 5%, it's still a really good deal, especially in an inflationary environment. So let's talk about that. We are in one. Inflation's not going away overnight. Why is real estate a good hedge for inflation? And if you look that up, if you look up hedge against inflation, and we are in inflation, it's not going away quickly, you'll see people say real estate or stocks. Why is that?
I mean, that's an easy one. That's why I'm here today, right? It's that 30-year fixed mortgage. A lot of people don't realize that a fixed rate mortgage for the duration of the loan doesn't exist really in any other country in the world, right? Because it defies logic. How can you get a rate of 5 or mid 5% when the inflation rate's 8 or 9%? And the beauty of that 30-year fixed is, no matter what happens, right? The cost of bread will double, the cost of rice will triple, rents will go up as well. Guess what won't change? Your principal and interest mortgage payment. And that is the wealth builder in real estate. One of the courses, and I'm sure you have to do your annual education on your real estate courses and stuff, but in the real estate CAR book, they actually have an article that kind of talks about the return over, and I don't remember the exact 20-year period, but they talked about the return of the stock market versus the real estate market. And real estate market over that 15, 20-year period had gone up 100%, and stocks had gone up 300%. So you're like, oh, wow, okay, stocks are way better than real estate, right? Well, wrong. The difference was that, in order to buy a $100,000 house, you only had to put 20,000 down, right? 20% down. The beauty of leverage really showed in this example, because once they factored in that you were able to take advantage of that 100% growth in the real estate market with, in some cases, 5% down, 10% down. If you're buying a primary home, 20% down, the actual factored out return was like 3,000% in real estate versus in stocks. And, that is the beauty of leverage overall, but that's also, the beauty of that 30-year fixed. And, as you're aware too, Kathy, as far as I've seen in my life, inflation statistics, as much as they can predict, you don't know what it is until the future. And they're saying 8%, 9%. It feels higher to a lot of us, with the price of everything going up double to triple that. And even at 8%, taking it at face value, you're making 2.5% on your money on these 30-year fixed right away, with the spread between, the rate and inflation. And also, to put it another way, is if you guys are sitting on $200,000 in the bank right now in a checking account, I'm sorry to say, but you lost 8 to 10% this year. This year alone, you lost 20 grand or more, just by not deploying those funds into, a good hedge against inflation vehicle like a 30-year fixed, rental real estate mortgage. So, that's powerful. And that's what I meant earlier, is people who've owned real estate over a longer time realize that the way you get wealthy building real estate is, with all these various factors add up over time versus, hey, I'm going to make a good ROI for a couple of years.
Very good feedback. Yeah. Well, in an inflationary economy, it's usually better to be the borrower than the lender as the debt sort of, becomes less over time. So I appreciate that you're the lender and we get to be the borrowers. Thanks. All right. Well, it's been great to have you here, Richard. I just want to say good luck on your race. You are now an official race car driver. Is that right?
Yep. I run in the Formula Drift Series professionally, and in May I'll be in Orlando. So unfortunately, I won't make your live event, but hopefully I'll get a podium.
Well, maybe we can get out and see you there. All right. Well, thanks again for being here on The Real Wealth Show. I really appreciate your insight.
Thank you for having me.
And thank you for joining me here on The Real Wealth Show. You can go to realwealthshow.com, as I said, and click on the Learn tab, and also get access to hundreds of educational webinars that go much more in depth than we can go here on The Real Wealth Show. So check that out, realwealthshow.com.
The views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.